first welcome everyone to the Oilfield Strong webinar series. We have this monthly first Monday or first Wednesday of every month presentation of various topics focused on the energy industry with a pretty good dose of environmental type issues. We do have a YouTube channel, as you all know, and so if after this presentation, if anyone wants to hear Vivek's presentation or you want to share it, that it'll be available there as well. Plus some other presentations from like University Lands, Earthstone, variety of other speakers that we've had recently. So it's kind of an interesting presentation that to have today, but I'm excited to do so. You know, when I sent it out, someone called and said, well, now they look kind of anti-ESG. Why are you doing that since you're kind of more focused on ESG? And I think there's a couple of things going on there. One is I like having a variety of opinions on topics, and whether that's ESG, environmental issues, the energy industry. And I think you'll see that Vivek has a very a different viewpoint than so many folks, but I think a very relevant and very important one, because kind of focused on, does it make sense? Does it make financial sense, logical business sense? And I think he brings up a bunch of good questions on scope 3 issues, understanding the cost benefit. And I think that's always very important for us as an industry to know, whether you're pro-environment, anti-environment, pro-ESG, or think that they've gone too far. I think understanding the different points of views, I think, are very, very important. And so with that, my introduction to Vivek, I heard him speak at an Intercom presentation in Denver about a month ago. Thought it was very, very interesting and had some wonderful points. And so he was kind enough to present here. He has created Strive Asset Management, obviously asset management, creating index funds focused on energy, on a variety of things, but on this particular one is energy companies, and trying to say, look, you don't need to focus on ESG when you're making your business decisions, capital decisions as an oil company. So as my guest, or not guest, but attendees always know, I do a terrible job of introduction. So Vivek, I'm sure I did not capture all that you'd want to be captured on Strive, but hopefully through this presentation and your comments, you can make yourself look better than I did. So with that, let me turn it over to you, and I appreciate your time.
I don't know about that, Greg, but thank you very much. About looking better, but I'll take the opportunity. You know, look, to say a couple of things, even in response to your helpful introduction there. I think that the characterizations of Strive as anti-ESG, I think in the media and otherwise, are, I would say bluntly, inaccurate. And one of the reasons I've actually been open about that is I find it very difficult to be critical of a movement that I can't even define. And it's not that I can't define, it's not for lack of studying it. I wrote a couple of books about it, or at least one book about it, and a lot of the scholarship I've produced over the last year. So I'm familiar with the discussion around the ESG movement. But I think to the extent I have a criticism of the ESG movement, it's that it actually hasn't yet been defined as to what it exactly stands for and what it doesn't stand for. And a lot of that comes from juxtaposing 3 letters in an acronym, where each of the words represented by those letters, E, S, and G, actually may have very little to do with one another. And so to have co-bundled them and to presume one best way of addressing the environmental issues, of which there are hundreds, one best way to address all of the social issues, of which there are hundreds, and one best way to address all of the governance issues, of which there are hundreds, and to say that there's one right answer to each of those hundreds of questions. And if you have the same answer to the E, you have to those hundreds of E questions, you also have the same answer to the hundreds of S questions and G questions, to me was reductionist. And there's the reality is there's a true diversity of opinions in the marketplace of products, in the marketplace of ideas, and in the marketplace of citizens of all 3 of those categories. And what we prefer to do is to advance the conversation to what I talk about as a post-ESG world. It's not anti-ESG, but it moves the conversation forward to discussing, I think, topics that haven't enjoyed enough debate in corporate boardrooms across corporate America. including in the U.S. energy industry. And so that's what I just wanted to say to kick things off in response to your introduction. I did want to check in, Grant, that you're able to see the slides, because it might be useful if I reviewed a select subset of the slides that I presented at Intercom. And if you could just give me guidance on how long to go before moving into Q&A, I can tailor this accordingly.
We tend to go for about 30 minutes, and that's inclusive of questions. We can drip further on if there's questions, and we can open up for questions, but that gives you a time frame.
So I'll take about 10 to 15 minutes to make some remarks, and then I'd love to engage with the group.
Based on your presentation at Intercom, I think there will be some questions on.
Good.
And I think that's a positive comment.
Yeah, and one thing I'll note at the start is just yesterday I wrote a letter to the board of directors of Chevron. Some of you may have seen it, covered in the Wall Street Journal or CNBC or elsewhere. I'm happy to take questions about our perspective voiced in that letter to Chevron's board as well. But I think the themes are highly relevant to what we were going to talk about at a high level. So look, I think that the critique that I have of the broader trend of stakeholder capitalism and its close cousin of the ESG movement in capital markets is different from Milton Friedman's criticism. Though I agree with much of Milton Friedman's criticism, Milton Friedman said that when companies are focused on social agendas, in addition to product-centric, profit-focused agendas, they're going to be less effective at making products and providing services effectively for profit, which then reduces the size of the economic pie, which in turn shrinks prosperity for everyone, and everyone loses, including the people at the bottom. That was the Milton Friedman argument. I'm highly sympathetic to that argument. I agree with much of it. My concern is actually the inverse of Milton Friedman's concern, though. It was not just that I felt that, and I worried that our politics was going to infect capitalism. I actually worried that capitalist overreach was actually going to infect our democracy. Because what stakeholder capitalism demands is that the political questions that we ought to sort out through free speech and open debate in a democratic society, important questions like whether and how to address climate change, whether and how to address historical racial inequity, important, fundamental, normative questions ought to be settled not by citizens through free speech and open debate in the public square through the political process, but by a small group of corporate actors who are empowered with capital in corporate boardrooms. And I think that was equally not just a threat to capitalism, but a threat to democracy. And that was the subject of, I happened to have it in the background. I didn't mean to do it this way. One of my two books that I wrote, that's the heart of the case that the book made, actually. Now, the story of how this went from being really a relatively fringe philosophy and a helpful one, right? I think that one of the things I acknowledged in my book is a lot of some of the most thoughtful arguments offered by proponents of stakeholder capitalism, some of which are partially persuasive to me, like the fact that companies had limited liability, a great gift that that society gave to companies. Well, the best argument, I think, for stakeholder capitalism is that, companies and their shareholders owe an implicit give back to society in return for that great gift of limited liability, which doesn't exist in the state of nature. So I explore a lot of these arguments. This was on the fringe in the early 2000s. But how did this sort of fringe and interesting intellectual perspective go from being a way to challenge the prevailing orthodoxy to become the new orthodoxy? And the story of how that happened, I think, is pretty clear, actually. It was the rise of passive indexation and the large aggregation of vast, unprecedented sums of capital in the hands of a small handful of market actors. Particularly, if you just take, for example, the top 3 passive asset managers in the United States, BlackRock, State Street, and Vanguard. Those are 3 firms that together manage over $21 trillion on par with the US GDP. But what they've done is they've actually aggregated the capital of everyday citizens who thought they were just investing in the market through passive funds, low-fee funds, to have exposure to the market, because the people who offered those funds at low fees said that they weren't even smart enough to pick stocks. Yet those same actors became self-proclaimed enlightened, all-knowing determiners of how to design an entire society. The very people who said they couldn't pick stocks are going to actually pick which values to advance using the capital of everyday citizens to do it. And I think even more alarmingly, using money of everyday citizens, many of whom did not even agree with the agendas that were being advanced in corporate America's boardrooms through their proxy voting power and through their shareholder engagement, through their exercise of voice as a shareholder. And so to me, that was a large scale fiduciary problem. We can call it a breach, but we can at least call it a gap where a small group of actors is using the money of everyday citizens to advance values in corporate America's boardrooms that most of those everyday citizens disagree with. That's at least a gap that demanded a need to be addressed. It was happening actually at such a large scale that it even raised what I worried about were anti-competitive issues that are best demonstrated through a thought experiment. I gave this thought experiment in my remarks in Denver, where, look, if you imagine that this group of people were the CEOs of the largest oil and gas companies in the world, and we got together on a Zoom call like this one, and we decided together to coordinate our activities to cut production, and then gas prices go up at the pump as a result. We have a word for that in this country. We call that an antitrust violation. It's a price fixing violation. It's cut and dry case, pretty simple. Maybe people will be going out with handcuffs, who knows? But somehow when the top shareholders of those same entities demand that they behave the same way, we celebrate that today as ESG-linked behavior instead. And I saw that as an anti-competitive issue because of the sheer scale at which it was happening, because these three firms are indeed the top shareholders or among the top shareholders of most publicly traded U.S. energy companies, of most publicly traded U.S. companies, period. And then comes in, I think, a conflict of interest that has escaped notice as well, which is that some of the very demands that certain of these firms make to firms to cut carbon emissions, resultantly to cut production projects, some of those same projects are actually well positioned to be picked up on the other side of the world by firms like PetroChina. But then you look at who's the top, some of the top shareholders of PetroChina. And it turns out that the same firm that owns about 5% of 6% of Exxon owns about 5 or 6% of PetroChina as well, and that's BlackRock. And so that raises a deep-seated conflict of interest to say that for the fund managers, it's fine to take from the left hand and give to the right. Chinese clients own Chinese companies over there. Don't impose any ESG mandates over there. And last time I checked, part of the premise was addressing and combating global climate change in the first place. By the way, shifting production to parts of the globe where methane leakage, where, let's just say overall dirtiness for the environment, far worse than it is when American production of the same oil and gas takes place here at home. Yet to even be doing it in a way that financially benefits themselves on the other side of the world, I thought was even a deeper seated and darker turn to the story that hadn't yet been sufficiently exposed. And the reason I'm interested in talking to you all, and I won't go through all of these examples, you can take a look at some of them on the slide, we can talk through them in the Q&A, but suffice to say that I believe the number one sector damaged by these ESG demands has been the US energy sector. I don't even say the energy sector because these demands aren't applied equivalently globally to Chinese companies or companies on the other side of the world, but to the US energy sector. Maybe you could include the European energy sector in this as well. But I certainly think that there's a strong case to be made that the U.S. energy sector, because even in Europe, a lot of this is dictated by law. But in the United States, a lot of this is dictated not by law, but just through shareholder pressure. After all, the U.S. actually chose not to ratify the Paris Climate Accords. You can debate that as a matter of public policy, whether or not that was a good American public policy decision. But if the U.S. did not ratify the Paris Climate Accords, the Paris Agreement, then it is not, as I said in my public letter yesterday, it is not Chevron's job to ratify it instead. And yet it's shareholder force in the boardrooms of many of these public companies that has caused them to adopt the same standards that could get passed through the front door in the democratic process in the United States. Maybe they passed in Europe, they didn't pass here, but where we're seeing them passed instead is not through the halls of Congress, but through the halls of the boardrooms of publicly traded companies. You see examples on this slide here in certain cases where even over the board's objection at Phillips 66, at Travelers, at Valero, in certain cases, well, for the first two, over the board's objection, adopting measures that advance not a pecuniary agenda, not a financial agenda, not a profit-motivated agenda, but a social agenda that may be well-motivated, but I believe ought to be sorted out through the political process rather than through the corporate boardroom. And the specific example that was the subject of much of my letter yesterday was the Scope 3 emissions proposal at Chevron, where the big three asset managers I mentioned earlier, supported a shareholder proposal that called for Chevron to cut its Scope 3 emissions. That includes not just Chevron's own contributions to emissions, but emissions all the way downstream in its investments, its employee commuting costs to work, its employee travel costs, even the use of its fuel by its customers to bring that down. And the question I ask is not whether or not this is necessary to fight global climate change. That's a separate debate we ought to have. But why is this in the best interests of Chevron as a business? Why is in the best interests of the owners of Chevron, which is the sole question that a board ought to legally consider? And I find it very difficult to believe that there's, having evaluated this to some extent, very difficult to believe that it would voluntarily be in the interest of Chevron as a business to commit to reducing emissions in these 15 categories that you see on this slide, effectively by forcing its customers. Its most valuable way to do, the most effective way to bring down scope 3 emissions is to sell less of its core product, oil, to its customers. It would be the equivalent of McDonald's voluntarily committing to reduce the body weight of anyone who has ever eaten a Big Mac without asking for any accountability or responsibility on the part of the consumer. That's what a scope 3 proposal effectively calls for an oil company, yet that received majority shareholder support from BlackRock, State Street, and Vanguard in 2021. And I do think that this relates to, I think a market phenomenon that I'm about to describe, which is the fact that the price to earnings multiple at which energy companies trade today is actually far lower than the price to earnings multiple that US tech companies trade at, or even the S&P 500 trades at. And why is that? Well, I'm going to just show you an interesting fact first. And this was just as of the Entercom presentation, so I haven't updated the numbers since then, but for ease, I'm just using the same slide deck.
Sure.
Energy share prices have dramatically underperformed the US tech sector over the last 4 years. But actually, the earnings growth of the energy sector has actually outpaced that of US tech, which actually surprises a lot of people. Usually, price to earnings multiple track the growth rates of earnings. Yet here, the price to earnings multiple of the US energy sector is much lower than US tech. Why is that? It's because of this US ESG-centric investment consensus that says that, okay, though we'll give tech companies and biotech companies a lot of credit for what comes after 2030 in a low interest rate environment, low interest rate environment causes investors to value cash flows in the very distant future, a well-known feature of macro investing, which we can talk about. For energy companies, the ESG investment consensus had the exact opposite perspective, which said that actually there's no oil and gas profits to be had after 2030, after 2040. So even if those companies are increasing profitability today, there's no multiple to apply to those profits. And rational investors can't apply a high multiple to those profits if the companies themselves are behaving in a manner that reflects the company's own beliefs that oil and gas profits are going away after 2030. And I think that the data for the massive supply-demand imbalance for global energy and for fossil fuels in particular reveals that view is simply false, which creates a generational opportunity for American energy companies, including publicly traded American energy companies, to fill that void by producing more energy. And so I went through some jokes here, maybe soon we'll have scope 4 proposals calling for reductions of emissions on the planet Venus, but I would have stopped at scope 3. There's a legal disclaimer that this is a joke. But at the end of the day, one of the things that we did was we launched a new energy index fund, right? I didn't want to just be writing books and talking about this. I want to contribute to advancing the conversation in corporate boardrooms. And so Strive is a new asset manager that competes with firms like BlackRock by bringing a different shareholder voice to the table, what I call a post-ESG shareholder mandate to the table across corporate America, mandating companies to focus exclusively on delivering excellent products and services to their customers and maximizing shareholder value that way, rather than pushing other social or political agendas in the boardroom. And our first energy index fund was an energy index fund called DRILL, D-R-L-L, listed on the New York Stock Exchange. It raised over $300 million in its first 3 weeks of trading. Just launched on, I think in August 9th, I think was its first day. And the key is, our message to the US energy industry is actually to drill, to frack, to do whatever you need to do to be maximally successful, financially successful over the long run, without regard to social, political, cultural, or environmental goals. And indeed, that is the first of the model shareholder proposals that we unveiled for the sector. And we unveiled a series of other model shareholder proposals, including those calling for rescinding any commitments to scope 3 emissions reductions, a model shareholder proposal that we advance and seek to advance across corporate America, that even hiring and compensation decisions should be made exclusively based on job qualifications without regard to other factors like race or gender or sexual orientation or political views. So some of this goes beyond the energy industry the answer is, at the end of the day, we think the tailwinds could be strong for U.S. energy. Some of those will be familiar to this group, but more importantly, in order to unlock those tailwinds for the U.S. energy sector, it's going to take a new voice at the table in the boardrooms of these companies to take off the handcuffs imposed on this sector by the ESG movement. And I hope that that gets us to a place where I believe we're going to not only have potentially companies that are more successful over the long run, but also even do better for some of the very goals that the ESG movement cared about in the first place. More production here at home and in places like Canada and Norway and the United States means actually cleaner energy production than shifting that production to places like Russia and China. Opening up conversations about sources of renewable energy that go beyond those that the ESG movement has blessed as acceptable. For example, Vanguard's ESG funds, I believe still to this day, by rule, exclude nuclear energy from inclusion in their funds. I think that there is no version of an energy transition that's meaningful that does not include and does not run through, have a path that runs through nuclear energy. So I hope that the voice we bring to the table isn't just a recitation of Friedmanite slogans that we all memorized in 1980, but a more honest assessment of what it is that it means to be an oil company, a gas company, an energy company, what it means to pursue excellence as an energy company, and what ways we can reopen honest channels of dialogue that don't talk out of both sides of our mouth, sometimes claiming that we're earning our social license to do business, while other times claiming that we're actually maximizing shareholder value. I think we prefer an honest conversation about what is it that maximizes shareholder value over the long run for an energy company. That's the job of companies. And the rest of the questions are still really important to debate. Let's do it through our public policymakers. So with that, I hope that gives you a perspective that at least is useful to kick off a conversation, Grant. And I look forward to engaging with your audience.
Oh, that's fantastic. Everyone, if you've got questions, use the on the bottom, there's a Q&A. You can click and be sure and or chat, whichever way you want to go, and we'll add those questions. Did have a couple to lead off with, though, Vivek, on just for kind of clarification, because you can come across when you say kind of they shouldn't worry about ESG. Then if you're not careful, then you could quickly appear to be kind of anti-environmental, but I don't think that's what you're saying. It's like, let the oil, because if an oil company doesn't perform correctly and do things the right way, they're going to hurt themselves ultimately. But I guess how should an oil company, in your world, how should an oil company handle environmental issues, not even ESG issues, environmental issues?
So look, I think that there's not a one-size-fits-all answer, right? Not all oil companies are the same. Different companies have different competitive advantages. When we talk about the energy transition, one of the distinctions that I like to draw is the distinctions between companies that have expertise in hydrocarbons and companies that have expertise in electrons. Molecules and electrons are fundamentally different areas of expertise. And so one of the things that puzzles me is to watch many companies whose core competencies are in molecules and hydrocarbons to invest instead in building de novo expertise in electrons to prepare for a so-called energy transition, when in fact, there's plenty of ways in which even companies that have expertise in molecules could have competitive advantages in areas ranging from carbon capture to hydrogen to, using pipelines, using the kinds of expertise in molecules and harvesting fossil fuels that still could help them in maybe more renewable sources of energy within carbon-based forms of energy, but assessing carbon intensity, different approaches to carbon intensity. So the first answer is, I think there is no one-size-fits-all answer. I think part of the problem with the so-called ESG movement is that it presumes one-size-fit-all answers. So what I think is the way that a given company should deal with it. I think the way for a company to deal with it is to ask itself, look itself in the mirror as a board and ask itself, what allows us to be most successful at selling products and services in a way that makes us financially most successful over the long run? Not because we're going to solve all of the world's problems that way, but because we're going to solve some of the world's problems, precisely the part of the world's problems that we are best positioned to address, and that other actors, philanthropic actors, political actors, nonprofit organizations, governments can address the other problems that still need to be addressed in the world in ways that they're best positioned to address them. So I think that it actually is a call for humility. It's not a call for unbridled greed. It's a call for humility to say that, you know what, here's a fact that bothers me. I mentioned in my letter to Chevron, but it's a fact that doesn't receive nearly as much attention in the climate change policy debate as I believe it should. But it's a fact that's not really dispute. That's not really up for dispute. No matter, anyone who's familiar with these facts is not going to dispute them. Over the last century, the climate disaster-related death rate, you might think that's an important metric, right? I mean, if climate change is a threat to human existence, one of the metrics that, to me, I think matters is what's the death rate from those climate-related disasters? The good news is it is 98% lower today than it was a century ago. Now let's ask ourselves, why is it 98% lower today? Is it because there hasn't been climate change in the meantime? No, there actually has been climate change in the meantime. Was some of that climate change man-made? Was it driven by fossil fuels? Yes, it was. But was the 98% reduction in the climate disaster-related death rate also attributable to advances and the accessibility and affordability and ease of use of fossil fuels by people around the world? You bet it was. Absolutely it was. And so I think that these are facts that belong in the debate. And so to sort of pretend that we need to end fossil fuels as an end-all be-all answer to advance human flourishing, I think is a short-sighted one-size-fits-all approach. And instead, the approach I advocate is one for humility, where companies and organizations ask themselves, what's going to make you most successful? After all, our legal system was set up a certain way to force company directors to ask themselves that question, to force asset managers to ask themselves that question. It got us this far over the last 250 years. I think it's going to be our best bet for the next 250 years as well.
So you take that the next step to all these folks talking about net zero. And I think you addressed that in the letter to Chevron, and there's been a bunch of companies talking about moving toward a net zero. I don't know how you document that. Well, if you can achieve it, and even if you achieve it, how do you even document it?
Yeah. So look, I think that there's a more fundamental question about whether net zero is even a desirable place to go. I think there's reasonable room for debate on this question. I personally believe it's not the right way to go. I think it is a low resolution fetishization of carbon as the problem, when in fact there's far too much discussion about net zero on the carbon side, far little discussion and too little discussion about actual additional alternatives like nuclear energy and advances in nuclear energy in the United States. I just think there's an imbalance in the conversation. And I think one of the things that a neat sounding phrase like net zero does is it becomes a lightning rod for conversation and attention that actually diverts more rigorous attention that we could spend talking collectively about what the right solutions are that different institutions are best positioned to deliver.
And when you start talking net zero, you do it in 2030, 2040, 2050, that's so far out there. It sounds good, but how do you ever get to that point? And you kind of see that with some of the different rating agencies, the MIQs and some of these others, that you can't really figure out how they're rating them, but it sounds good. So it almost kind of gives cover to these companies, but does it really achieve anything?
Yeah. So I think it mostly does not, is the answer to that question. And I think it's mostly, even if well-intentioned by some, I think it's net harmful. But at least we should be at a place where we need to be able to debate that openly in the boardrooms and openly in our democracy. I mean, if that's what society decides is the trade-offs involved in going to net zero, then do it through the front door. But a corporate boardroom effectively making that decision for the rest of society at large, I think is part of what drives modern populist backlash. And I think speak of sustainability, I think that's unsustainable for a divided democracy to not have an apolitical private sector. An apolitical private sector is part of what unites us across our otherwise unbridgeable divides right now. And I don't think it's going to be societally sustainable to continue to politicize the private sector to settle these political questions that should be settled through the front door of our political process instead.
Got two questions coming in from one should be a quick answer. What elements of ESG are utilized as criteria in any, if any, in selecting energy stocks for your fund?
So our as I alluded to before, ours is an index fund. It just tracks an index of certain of the largest energy companies in the United States. So we're not picking stocks. It's not an actively managed fund. The key difference is the voice and vote as a shareholder. And so our voice and vote stands for what we call the pro-excellence agenda. devoid of any other political, social, cultural, or environmental goal, we tell companies to focus exclusively on delivering excellent products and services for profit and to maximize shareholder value that way, full stop. So that's the way to think about the difference or the distinction that we see and bring to the table as Strive is our voice and vote as shareholder.
And this is a good question from one of the preeminent private equity investors that I know. And I don't know if you want me to give your name, so I won't, but at least stroke your ego with that statement. But in it, it says, in your opinion, and I'm believing, Vivek, that's your opinion, not mine, how much of BlackRock's public ESG activism is marketing to ideal, and he put woke customers, and how much is political protection from Democrats who would otherwise be inclined toward antitrust discussions around BlackRock's AUM?
So I think it's a very interesting question. I think there's no one size fits all answer to this. I discuss a lot of this in my book. I think there's a multi-factor causation set here, but probably one of the most important ones that's under discussed and underappreciated is actually there's some truth to both of those, but is a third one that I'll give you, which is that actually many of the large pension funds in blue states have effectively required asset managers to behave this way. So CalPERS or the state of New York, I mean, things that they'll say is, look, we don't want to do business with a firm that does not make firm-wide commitments to the Paris Agreement, to net zero standards by 2050. We won't do business with someone that isn't a signatory of the Climate Action 100 Plus network, which, by the way, is a dues-paying network of asset managers representing majority market share in the global asset management industry. $60 trillion worth of capital is a signatory there. And then there's a parallel association of the investment consultants that tell state pension funds how to invest, which have also signed a very similar parallel pledge. And so I think that in a certain sense, when BlackRock or State Street or Vanguard say, this is what our clients are demanding, there's a certain truth to it that certain of their clients, some of their largest and most vocal clients, have been demanding it. But I think the fiduciary gap arises when the rest of their clients then get pulled along for the ride, even if they didn't know they were being pulled along or didn't want to be pulled along for that ride, which in turn is why the market, I think, demands other solutions, which led, for example, to the birth of Strive, to say that, you know what, people deserve a choice. It's a free country. So if with your own money, let's say you're the end capital owner, one of the idealist customers, as you put it, and you want to say, look, I want to advance environmental goals and social goals and racial equity or whatever the goal may be with my capital, then by God, it's a free country and you're free to do that, right? You could focus on maximizing your profits and then use that money philanthropically. You could say, actually, I want to mix the two and do it with my own money. But here's what you can't do. You can't do it with someone else's money without their express consent. And that's what's happening on a multi-trillion-dollar scale today. That needs to be solved.
You talk about Chevron, and it's really all of these issues are very focused on these larger companies. Shell has had a lot, Exxon. How do you think this plays out to the next level, the Diamondbacks and the Pioneers and the kind of the more of the mid cap or the independents?
Well, I think if you're public, it touches you. At the end of the day, if you're a public shareholder, most of the large shareholders of public companies today are these large asset managers, these large index funds. You're not going to escape it if you're a public company in today's climate. Now, I think it even does hit private companies, as many venture capital firms, private equity firms have now forced on them by their limited partners, who include some of those same institutions that I described earlier, are saying that if you don't have an ESG policy that you're vetting your private companies according to, that you're bringing to the boardrooms of your private companies, we're not going to give you that $100 million check for your $3 billion fund that you wanted to raise. And so there's a trickle-down effect. Scope 3 is actually another way of getting that trickle-down effect from public companies to private companies, where part of Scope 3 emissions is everyone in your supply chain, smaller suppliers, smaller customers, smaller business partners. If you're in charge of, as a big company, from Amazon to Chevron, in the position of adopting a Scope 3 reduction plan, well, guess what? There's also a lot of independents, a lot of private actors who are in your supply chain, either upstream or downstream. And that's effectively how this permeates and affects the private markets as well. You're seeing it affect not just investments in publicly traded companies, but also lending behaviors of banks and other financial institutions. So I think that this is not just in the brain of the financial systems body, it's in the circulatory system. It is in the blood already. And I think that that's part of what made it so pervasive. It's ubiquitous. But at the end of the day, I also am a big fan of making sure that people don't reflexively resort to state action, which we're starting to see in some of the public debates now, to solve this problem, if it's a problem that could first be mostly solved through the market. That's why I stepped up to the plate by founding a competitor. That's what Strive is all about. But I hope that actually more competitors step up to bring this diverse perspective to the table. And I'm optimistic. I predict that you're going to see a lot of capital owners, everyday citizens, and even states say that, you know what, they may be in breach of their fiduciary duties to those everyday citizens. And you're going to see more of a distribution of capital across a wider range of actors rather than the concentration of capital that we've seen that I think supercharged this trend.
One additional question. You talk about scope 3, and that's an easy one to, I think, to attack, or not attack, but really question, because it is so vague and hard to calculate.
Yet it's everywhere. Yet it's everywhere, by the way.
Yeah.
Yet it's everywhere.
And as you put in your letter, it's the multiplication effect. It's just on, but what about scope 1 and scope 2? Those still have some challenges also on documentation, there's redundancy. It just,
I agree. I think there's room for reasonable debate on each of them. I like to start with the lowest hanging fruit. If you're driving positive change, let's drive positive change where it should be most obvious, and then let's work our way up the chain. Is taking a natural resource, capturing it, putting back in the ground, and then making more money off of it again, or methane that leaks, liquefy it, sell it as natural gas. Great. That could be good for the environment. It could be good for scope 1 emissions. Call it carbon capture, and you make more money. I'm not against this for the sake of being against it. In fact, in that case, I'm very much for it. I think it's a profitable business activity. But I think the lens that companies ought to bring to the table is what's going to make them financially most successful over the long run. And that is how they make society a more just and environmentally respected and livable society, is when companies avoid engaging in the kind of corporate and capitalist overreach we've seen in the last 5 years. And I at least hope that's a perspective that challenges, I think, some of the assumptions of the last 5 years. And whether or not it's 100% correct, at the very least, I hope that it challenges each of us to think independently about questions rather than following what has quietly become a new orthodoxy.
You mentioned your letter to Chevron. I thought it had a lot of good points, some that dovetailed with this, some went deeper in. Is that on your website?
It is. Yeah, it is on our website. Yes.
Here's your chance to do a quick ad for everyone, because I think it's worth, and I'd highly recommend y'all going and reading this this letter. It's a good read, but it brings up some points that he brings up on scope 3, on kind of just how companies should make decisions. Where could they find that?
So I would say you can go to our website to just learn more about Strive overall, strive.com. So Strive, STRIVE.com. And if you go to the Our Products page, it'll tell you about DRLL, which is our first ETF. There'll be others in the future. If you go to the news section, I think the first item on there, or one of the first items, should be the letter that I submitted to Chevron's board yesterday. And our goal was to take this from a 50,000-foot discussion to really, let's get in the weeds. Let's roll up our sleeves a little bit and talk about one particular case study of a company. And one of the things there's a lot of things in that letter, but one of the things that maybe we can close with that's kind of interesting is even how much vacillation there has been amongst even the asset managers who voted in favor of a 2121 proposal at Chevron. So BlackRock, State Street, and Vanguard all voted in favor of the 2021 Scope 3 proposal. They voted against a 2022 Scope 3 proposal that was somewhat similar. And there was just so much in the stated reasoning for why that it sort of made clear why we need to be debating this more openly in the open, where BlackRock and State Street said their stated reasons for changing their vote was that Chevron already aligned its behaviors with the 2021 vote. And State Street even came out and took credit for it, said that the company has been responsive to our engagements with the company. And that's why we're not going to give them a spanking again in 2022. The company, for their part, said that actually in their discussions with some of the shareholders actually didn't really believe what they intended to communicate through the vote. So even though they voted that way, they didn't actually believe in their vote. So the company didn't actually believe that the shareholders actually believed it. And then BlackRock in its corporate governance department said the same thing that State Street said. The reason they didn't want to slap Chevron again is because Chevron was already listening to what they said in 2021. But Larry Fink came out just a couple months later and said that actually the reason was that he's always opposed Scope 3 and that he doesn't want to be the world's environmental police, while making no mention of BlackRock's own vote in 2021 or BlackRock's stated objection in 2022. So it's a mess. It's just a complete non-transparent mess. And I think that whatever the right answers are, our best chance of getting there is going to be through clarity and open and honest communication, which I think many of when I say I mean our culture's boardrooms would benefit from. And I think it's totally lacking today. And that's what moves me to at least bring a diverse, for all the discussion about diversity and inclusion, a diverse perspective to corporate boardrooms for the sake of not all knowingly having all the right answers myself. I don't, no one does. But to be able to spawn the kinds of conversations that can actually get us there through free speech and open debate in our culture, in our boardrooms, in our country. And I think that that's what we're missing today, that hopefully we can restore starting with our capital markets.
Fantastic. Those are probably just the appropriate concluding remarks. Vivek, thank you very much for your time. Hopefully attendees, y'all saw the reason why I wanted him on. It just fabulous speaker. His resume said that at one time he was attempted to be a stand-up comic. I saw a little effort of that, and looks like you're going to be a much better asset manager than comic, but no.
It's a low standard, but so I like to over deliver.
There you go.
Hey,
thank you very much.
If you send me the emails of everyone on this, actually, if you just send me that, I can actually send the letter to everyone on this list to make it easy for everybody.
I'll do that. I think they'd enjoy reading it. I think that'd be good for them to see. Very good. Thanks, everyone. We'll see you next month, first Wednesday.
Thank you. Thank you very much.